Today, I look forward to discussing with you all a handful of strategies for retirement planning for an executive. And each of us have different goals and desires that makes our retirement ideal, fulfilling. We have different numbers that we need for retirement. There are some things that we all share, and there's some things that are unique to each individual situation. When it comes to executive planning and some of the strategies that we'll go over today, this could be you at a startup where you don't have quite the income to just pay someone. So we offer shares in the company, and where there's different ways to structure them, and there's different tax benefits and some tax consequences if we don't go about it the right way. There's the example. I think the person who painted the mural for Facebook. It's one of those interesting stories where Facebook didn't have the money. It's Meta now, but they didn't have the money to pay this person for the mural, so they gave this person shares of Facebook. And then they put whatever stipulations underneath it. And when he sold those shares after Facebook went public, how much do you think he actually ended up being paid for his mural? And if you would have guessed millions of dollars, you'd be correct. He actually made somewhere around, I think, $40 million for that mural that he painted. And it probably would have been paid 100, maybe two, $300,000. And that sort of shows the idea of why companies do incentivize their employees with stock options, and also why sometimes it's actually a better benefit for the employee than being paid their normal paycheck. And some of the benefits that we'll go over today, and we'll go over a couple of them. We'll go kind of high level because it's very specific and very unique. Every company can sort of structure them a little bit differently. But the plan today is to be able to go through some of the most common ways that I've seen incentive-based stock options and non-qualified stock options and deferred compensation plans. So you can see Rebecca and Robert, their plan is fantastic. They are have 100% probability. They have the money that they need, and when you have the income to maintain your lifestyle, to check off all the boxes, we do like the idea of ensuring that if we're building a legacy, that we have the most tax efficient approach possible. And also, you can see what we're able to accomplish by giving them more ways to access and to save and to defer their money. Because if you are an executive, then you already know that there's caps on almost everything. So currently in 2025, you can put 23,500 inside of a 401k or 403b or other pre-tax plans. You know that the income that puts caps on your Roth, I believe that number escapes the top of me for a couple. I think it's like 185,000 or something like that. Maybe no, it might have been 203,000. But there's a cap on all of these things: how much I could put in any given year, how much I have as income that I can do, and sometimes you're still sitting there with money that you would like to be able to allocate, that you don't need to spend it. You take the trips, you have the cars, you have the boats, you have everything that you can need, and you just don't want to be paying taxes on it because you don't know where to put it. And when you're in that type of a situation, it normally makes sense to start exploring some retirement planning strategies that are unique for executives. And so we will go through a few of those as well. So in this particular situation, you can see that we have a net worth of 1.5 million. We have 80,000 in a bank account between our checking and our savings accounts. We have investment accounts. So you can see we have our 401k, 200,000 set aside in there. We have non-qualified deferred compensation plans, 150,000 that's in there. And so a non-qualified deferred compensation plan, the main difference that you'll see is, right, you already know it's qualified versus non-qualified. Well, who are we qualifying with? And we're qualifying with the IRS. So ERISA, the Employer Retirement Department, they make sure that there are certain things they check off. So a retirement plan can't be discriminating against any employees. It has to have certain rules that are set aside to ensure that the government says, all right, this looks good. As a reward, I'm going to allow you to defer some of these taxes, write off some of these money that you're putting aside of it, but that every company doesn't need to qualify for that. You maybe do want to offer your executive employees a non-qualified plan. So all that generally means is that we have different taxes as far as the way it's treated, and it's not treated as a qualified, and we'll go through that. But if you're in a situation where the money is not the most important thing that you need right now, that you really want to make sure that you have all the money you need in retirement. Because if you're an executive, you find that it can vary how long you'll work. That you may be done when there's a merger. You may be done in 5 or 10 years. That you don't know how long you'll be there. And so normally when we have the money that's coming in, think of it almost like a professional athlete, they know that their career is a relatively short amount of time. And as a result, they tend to have to allocate their money in a way that goes longer than the average person who retires, where they maybe only need 20, 30 years. You can be an executive that might need 30 to 50 years to be covered. And so that is the case. And we normally want to put money aside in other accounts. We have our joint investment accounts, we have our health savings accounts. We had added that. You guys know I'm a big fan of health savings accounts. I think most people are when you see what it does. We know that on average, you're going to have about $350,000 over the life of your retirement and healthcare expenses. We know that for an individual that it's going to be closer to $150,000. If you have this expense over the life of your retirement, and your health savings account allows you to put the money in tax deductible, grow the money tax deferred, which means it's not taxed each year that your money grows. And then you take the money out tax free as long as it's on healthcare expenses, which we know we're going to have in retirement. It just is a no-brainer, in my opinion. If you have access to a health savings account, then it's normally going to be a great approach and a great place to place your money. And I'll bring on the whiteboard and I'll go over maybe the order that you should allocate your money when you have extra money. So in this one, Rebecca also has an incentive stock plan. So it's a private company. She has $300,000 of company stock. And so that is what we're going to focus on when we describe that. In fact, I can probably go into a little bit. I could probably share a little bit with you right now as far as how that is structured, because it is something that we do, that we understand high level, but it is also something that we can do a little bit better on. So when you look at an ISO is what I'm gonna call it, so I don't have to keep saying an incentivized stock option. So you have a private company that has stock. And the reason we normally do this is because on average, if you're an executive, then you're gonna have taxes that are probably above 30%. And so if you're sitting there and you have your ordinary income, that's what the OI stand for. So you have your ordinary income, and that's going to be somewhere, it could be at like 37%. It's going to be the upwards amount. Well, if we're able to have it taxed at the long-term capital gains rate, well, it's possible for us to be at 15 to 20%. And so just looking at that, which would you rather be taxed at? Would you rather be taxed at 37, almost 40%? Would you rather be taxed at 15, 20%? I think most of us would want to be taxed at that 15 to 20%. So what ends up happening, and there's a few things, and your company, what they'll do is the board will meet and they'll say, you know what, Dre is doing a phenomenal job. I think we should incentivize Dre to stay here as long as we possibly can. So let's offer him equity in the company. And I'm someone who loves equity because you've seen, as far as our income, our payroll, and what we receive, the way it's taxed is not as favorable as the other six streams of income. So if you're able to add the additional stream, have equity in the company, you give yourself the ability to be paid what you're worth. Because if you grow the company, the stock grows, and then the value that you receive from that stock grows as well. So the board meets and they say, all right, Dre's doing a great job. We're going to grant him some stocks. And then we'll say the stocks are at $5 a share. That's what's currently in. So we're going to grant Dre some stock. So what we'll do is we'll say, right, so we'll just say it's this year. So we'll say he did it this year. So 2025 is either we're going to grant Dre some stocks. And what ends up happening is if we just said we're going to raise Dre's salary, it'll be taxed as ordinary income. So it'll be at my 37%, which is like, all right, well, look, you gave me a raise, but then Uncle Sam took almost half of it. So I'm not as excited. But if I give you the stock, now you have the ability to access the long-term capital gains. So there's two rules that you need in your ISOs to be able to have it taxed at long-term capital gains. So number one is the exercise. And then number two is going to be the grant. So 2 years from your grant, 1 year from your exercise, you need both of them to be accomplished for you to qualify for long-term capital gains. So what does that ultimately mean? That means that what happens is in 2025, they say, hey, great job, Dre. And a lot of the times what we end up seeing is it's not, most of the time you don't have access to it anyway. So as far as the 1 year from exercise and 2 years from grant, most of the time you don't have access to all of the stock that's granted to you because again, they're trying to keep you there. So for the most part, you would normally would have like a 4-year cliff. So maybe at the first year, they give you 25% of it, then you get another 25 each year until you have it all after the 4. But if you're in a unique situation where they just give it all to you that first year, You would say, all right, the stock's at $5. They give it to me at $5. I'm not going to sell it. There's really no benefit. I got it at 5 and it's worth 5. If you waited a year, so now it's 2026, and the stock is at $10, you might say that this is the day for me to exercise the stock. So I exercise the stock price. So now what you have going on here is a couple things. I probably should change the color because it's going to be a lot. It's going to be a lot going on. But yeah, I'll probably change. So we'll change the color real quick. So what you'll see here is this amount. The difference is $5. And that, in our fancy term, is called your bargain element. Now, this isn't as big of a deal right now, but it can ultimately become a big deal. So now we have the 1 year, and you see we've already had the stock for 1 year. We have the ability, if we technically wanted to, we could immediately exercise and sell. But if we exercise and sell, it's going to be taxed as normal income because we didn't qualify for the long-term capital gains, which is, it needs to be 1 year from exercise, 2 year from grant. And we have not accomplished either of those. It's just been 1 year from grant and 0 years from exercise. But sometimes it's so enticing that we're just like, look, I don't really care. Tax as ordinary income. I don't know if the company's going to be around in the future. I'm not that comfortable. So I'm going to go ahead and take my win now because if the company goes bankrupt, then I lose the benefits that I was going to receive, which is the fair observation. But if you are comfortable with the company, you have now exercised it at $10, and then you'll wait another year. So now it's 2027. And let's say the stock went up to $30, right? So now the stock is at $30. As a result, you have qualified for long-term capital gain treatment. And what we end up doing is instead of you being taxed at, so what's the difference here? So 30 minus 5 is 25. So we basically receive $25 a share, and that will be taxed at your long-term capital gains. Right. And so you receive that benefit because you were able to make it the year and then the 2 years. So you have the 1 year from exercise, 2 years from grant. 2027 is 2 years from my grant and 2025. And then it's 1 year from my exercise in 2026. So now that $25 profit is taxed at long-term capital gains that I receive both of them at that benefit. And that's why a lot of companies offer incentivized stock options, because now I'm not being taxed with ordinary income where my salary and then my stock options, but my stock options are taxed at a much more favorable rate, as long as you're able to wait it out. And so if you're waiting it out, now you have a lower tax options, because that's basically the name of the game. Once you have the money where you're an executive, you get paid very well. Now we have to figure out how to keep more of your money in your pocket. And so that's what you would do. Now, if you had just while we're here, if you had a non-qualified, that's supposed to be a Q, stock option, or you may also see it as just NSO. They don't actually put the Q for qualified. They're both the same. A non-qualified stock option, you don't actually get that benefit for between the exercise and the grant. So that $5, you would actually pay that. Man, I don't know what's going on with Margaret. So that $5 you would actually pay. Where is something going on? All right, let me erase that because it's not supposed to look that way. All right, so let me erase that. We'll try it again. See if it works again. Okay. So that $5 that you would receive, which would be the difference between my exercise and my grant, that is going to be taxed as ordinary income. So if you have a non-qualified stock option, you just kind of have, that's just what happens. It's a part of it. You don't have the ability to have the long-term capital gains, but you do get to buy the stock, which is the huge benefit. So you do get the ability to buy the stock if you like the company and you believe that your company is going to grow. Then everything after that. So once you have waited the year, now everything greater than the $10 is long-term capital gains once you exercise it. So everything greater than will be the long-term capital gain. So you still receive that benefit as well. And so when you're an executive, the main thing that you need to keep in mind is, how do I set this up? Is this all going to be a taxable event? Because you could have over $1 million in stock options. And if you have to cash it all in, because what they'll do, and you have to read the document, but they'll have rules in it that says maybe 3 months after you terminate employment or retire, you have to sell them or they go away worthless. Because remember, they're incentivizing you to stay there. So it's structured in a way that if you leave, then they lose the value. So if you have to sell all of them at the end because you did not sell any along the way, you could have a whole bunch of a taxable event at the end. The other thing is most of the time they structure them where they're only good for 10 years. So with it after 10 years, you have to sell them or they're no good. And so you end up having to set up a plan where maybe you do, and I think the limit is like $100,000 every single year that you can do. So if you have $100,000 that you can do and you have a percentage of your ISOs that are coming into long-term capital gains every single year, then it might make sense for you to have a plan in place to where you're able to start allocating some of this money out because there's so many rules that are set up. You don't get to keep it forever. You have 10 years, 3 years after you retire, or 3 months after you retire. And then there's limits for each year. Uncle Sam says you can only do like 100,000 each year. So it becomes very important for you to have a comprehensive plan in place to ensure that you're not giving yourself that something that was supposed to be a benefit and you end up with a very large taxable event because you weren't able to move them along the way. Does that make sense? Hopefully that makes sense. Because I do know that that's a lot of people would naturally be thinking about that. So that's what we in large part had to do with this particular plan. We had to take the time to say, all right, what are the dates? When were they granted? When did you exercise them? How do the taxes look? And then we had to start putting the plan in place for each individual step. We were able to say, all right, this is the amount we're going to live this year. And then we move that going forward. And then we have our mortgage, we have student loans that are left. Property is worth about 1.2 million. And then they have $1 million in term life insurance, each of them a 20-year term. As far as the goals that we had, they both love the work that they're doing. So they said they want to keep working to like 70, 75. And why not? If you love what you're doing and someone's willing to pay you to do it, you find that a lot of executives, right, we're type A, we're high achievers. And so the idea of just kind of hanging around in retirement doesn't feel as exciting. And so we do end up working a little bit longer and we just find projects to lead that we're excited by. So you find that a lot of executives will be on the board of nonprofits. A lot of executives, they find a new purpose where they're more mission driven. And so they do end up still using their leadership skills in a way that makes sense. So our current expenses, I believe they're close to like 9,000 a month, and they plan on lowering that to about 7,000 a month in retirement. We do have the average healthcare expenses that we always maintain, and then we have the long-term care. It's all on average, it's going to be 7 out of 10 people. They'll have one long-term care event at least, and that on average is about $150,000 over the life of your retirement. And so we went ahead and we put in for 2 years, and that is already in their plan. So they don't have to worry about that. They do have a vacation home. They do like the idea of moving, and I think they wanted to move. I think it was a beach home that they actually wanted to get, and then that was about $800,000. There was a niece that they wanted to pay for college for in 2030, so we had that set up. And just so that you know, when it comes to paying for someone's college, you have a few options that are available to you. One of them is you could just open up a 529 plan and you can pre-fund it. You can pre-fund it for 5 years. So I believe it is $18,000 this year, and then you can do 18,000 times five, and you can pre-fund it out. Or you can pay the college directly. So for medical bills, for college and different nonprofits, if you pay them directly, it ends up being a non-taxable event and it doesn't count as a gift. Because if you gift something to someone, then they have to claim it and then you have to claim it. Like you have to fill out a gift tax form. But if you pay the institution directly, if you pay the hospital bill directly, it's not a taxable event. So I didn't want to share that with you. And so we were able to take care of that. And then they have the vacation goals where they didn't want to travel a little bit and they wanted to travel in style. So we said that'd be about 25,000 based off of what they wanted to be able to do. Now, this particular plan, so we did have 100%. You can see we have upwards of somewhere between 3 million to 26 million is what we're expecting. And that we're going to be somewhere in that median of about $10 million. They'll have that left over. And so then you move into estate planning because you have to figure out what to do with that. They have a variety of allocations. They're probably okay for where they're at. But maybe a little bit on the aggressive for normal people that are this far in their retirement. But as far as their risk tolerance and the type of stocks that we chose, it works for them and they're playing very well. And then the saving rate is about 20%, which is normally what we're going for. We're saying, hey, if I can save 20, 30% of my salary every single month, I'm going to be able to purchase my freedom. I'm going to be able to have a wonderful retirement. And we were, and, there are no exceptions. So we're able to take advantage of that. And so when you look at the balance sheet, their assets about 2 million, liabilities about 550,000, at least about 1.5 million that's left over. And then the investments, we are going to tame it down just a little bit as we get a little further into retirement. And then we'll move completely into, well, not completely, but we'll move more into a balanced approach. We don't need to go into preservation mode, but we definitely can move into a balanced approach. And so when you're looking at the way we designed the retirement plan, we did not make a lot of changes. Everything that they wanted, we already were able to accomplish the goals. We've really been working together, and it's very clear as far as how their retirement is, what it looks like, and how they have to allocate their money. We already have the ISO plan in place to where we know each year that which percentage of our grant or of our ISOs are long-term capital gains, and then we're moving the money and we're taking the lower taxable events. And you can see that right now we're going to take Social Security at 70 because everybody's going to be working. So there's no reason to take Social Security early. And then we have a retirement spending smile. The idea is that we're going to spend a lot of time early on traveling, enjoying ourselves, doing a variety of things. And then as we get later into retirement, we're going to slow things down a little bit. And then that's kind of where the bottom of the smile shows up. And then at the end, we normally have higher expenses for healthcare expenses, and then that's how the retirement smile normally goes. And that's how most of our retirements are. We go pretty hard in the beginning because we have a whole lot of things we want to do. We're like, look, I got my time back. I can travel, I can do things, I can wake up when I want. And then when you're retired, you're like, man, I'm still waking up early. You're like, wait a minute, I thought I wanted to sleep in. You're like, I don't really want to sleep in. And then you have all the time to yourself, and you're like, man, I would love to be able to fill my days up with something. And when you have the plan already set out where you know what you're going to fill your days up with, and whether it's trialing and erroring, whether that is just sitting and talking, it helps you out a lot. And so they had that. And then we have the vacation home they're purchasing in 2030. I believe we're going to pay 50% down and the finance the other 50%. But and it's completely one of those options where half of one hand and doesn't, or half a dozen on one hand, six in the other. I forget how it's said, but you know what I'm trying to say. It was definitely something that they had the personal choice for. Now, when you look at the taxes, which is kind of where the main focus is, when you're able to achieve the goals, you have the money. It's really about how we structure it so that you keep more of your money. And so everything from ensuring that, well, okay, we're at 10 million. So do we need to look at having trusts that are set up so that we can transfer the assets to some of the children now before they appreciate more? Do we need to set things up for the spouse? So we're able to put a lot of these moving pieces in place, and all of that starts with having a tax plan that naturally makes the most sense in accomplishing the goals. And so you can see here what we ended up doing, and it varies. It always varies because it depends where the money is at to know what makes the most sense as far as limiting our taxes. So in this particular situation, we have money in taxable accounts, tax-free accounts, and tax-deferred accounts. And then we did the withdrawal strategy of taxable first, and then we did tax-deferred second, and we did tax-free third. Because we're already in the highest tax brackets, we actually did Roth conversions anytime that their taxes were going to be below 35%. We already were used to that. It's no reason for us to be stuck with a whole bunch of money that we have required minimum distributions at the end of retirement, where we're taking out extra money that we don't want or we don't need, and it all becomes taxable income. So in this particular situation, setting their Roth conversions at 35% made the most sense for them. And then how it ended up working out is we had about $650,000 more in tax adjusted ending assets. So we're able to increase the amount of assets that they had. They paid almost $400,000, or they will pay almost $400,000 less in taxes. And they'll have about $1.5 million of money left inside of their investment account for their generational wealth because they were not required to take it out. And so we were able to set it up in a way where now they were able to pass on an additional $1.5 million to their loved ones, to their nonprofits, to the colleges, to the charities of their choices, versus being stuck with having this tax bill. And now we're paying taxes and then we're giving the money to the charities anyway. So that ended up working out very well for them. Now, of course, when you're at 100%, it's one of those things where you actually, from a stress test perspective and concentration and all that, the main thing that we had to focus on to ensure that their money lasted is sometimes when you're given stock options from your company, you're over concentrated in that company. And if something happens to that company, then your whole retirement could be shifting significantly in a very short amount of time. That we can't forego and just ignore the diversification and limiting risk that we normally use. All of those approaches, just because we have the benefit from a tax perspective of being able to have ISOs inside of the company that I love and I've been working at, and I believe it, that there is their need to have a plan that ensures that you are selling some of these so you can just diversify your assets. And not only from a tax perspective, where I don't want to be stuck with everything at the end, but even if you're able to structure it in a way that allowed you to take all of it, your concentrated stock when you retire, and they'll give you 5 years to take it in. I don't know if that makes the most sense for everyone because we are putting all of our eggs in one basket, and it is something that we aren't 100% sure. There, something may happen. We've all been there where the ownership changes and they sell the company, and the new ownership just kind of tanks it. And depending on the new ownership is and what their goal is, we don't know what's going to happen to the company. And so, for a lot of times, when the money is set, it becomes much more important to strategically allocate the money in a way that limits risk, limits taxes, and maximize the returns that you can have in your overall retirement plan. And so this one, that is what we ended up doing. If you enjoyed it, if you have any questions, you can go ahead and ask them. Hopefully that made sense for you. All right. See here, and we can answer them. My man, Rodney Cooper. Thank you, my friend. I like this topic. Great explanations. I appreciate you for sure. For sure. Rodney Cooper is a financial planner that deals with a bunch of business owners as well. He answers these same questions. So I know that they always are asking because it's true. A lot of times the first goal is to get the money. Like, hey, well, what I got to do to get the money? And then when we get the money, it's like, all right, what I got to do to keep the money? And keeping the money is what I think is where financial planners add their value because you know you're a master. You've been able to achieve certain goals and accomplish everything. And then you're sitting there with the money, and now you got to figure out what to do with it. And I know that there are people out there, and I don't even argue with them that will say, hey, financial planners don't add any value. You can get an index fund and be off on your way. And it's true that you can get some value from that. But I think it's equally true, and I don't think it's a controversial thing to say. I think at some point that everyone that has a certain level of wealth, they all have financial planners. I don't think anyone thinks that, I don't know, pick your billionaire that manages their own money. I don't think anyone thinks, pick your probably, I don't know, let's say it's like 20 million that we'd all say, hey, look, once you have more than 20 million, you should probably just have a professional that spends all their time finding ways to read these new tax documents because they change every year and they're on your side and they're a member of your team. I think everyone should have a team. You probably should have an attorney, you should probably have a financial planner, you should probably have an accountant. Then if you're someone that's a public, you should have someone that handles your PR and things like that. That the skills that you have, we leverage off each other. And that's definitely the benefit. All right, retired 2009. I appreciate that. He said, thanks for this presentation anytime, of course. And he says, I've retired for 5 years. I appreciate that. He says the videos really help. Look, you're retired 2019. I appreciate that. Okay, if you found value and you have the next topic, I'm going to keep on adding retirement planning strategies. As always, I'm Drake Riggs with City Wisdom. Until next time, stay safe and enjoy life.